Hello, and greetings from the headquarters of the International Energy Forum, the global home of energy dialogue. My name is Tom Ashby. I'm the head of global communications at the IEF. One of the important mandates of the IEF is to facilitate dialogue between energy producers and consumers to protect energy security, market stability, and transparency. As part of this dialogue, we publish a report every month analyzing the leading oil market outlooks published by the International Energy Agency of the OECD, the Energy Information Administration of the US, and the Organization of the Petroleum Exporting Countries. This 40-minute webinar is designed to give market participants deep insights into the global market dynamics and to enhance transparency. So today, we're joined by two renowned oil market experts to discuss the demand and supply balance for the global oil markets. We're pleased to welcome Jamie Webster, Partner and Associate Director at the Center for Energy Impact at BCG, and Rory Johnston, Founder at Commodity Context. So without further ado, let's get on to the first question. Jamie, Rory, I don't know who wants to jump in here first, but last time we held this webinar, in fact, Rory, you were here in mid-September. Brent was on the rise to the mid to upper $90 a barrel, but now the price has retreated to the low $80 a barrel. What do you think's changed, and is there anything in the agency outlooks that explains the pullback in prices?
I'll throw off a comment quickly here because I was at that last webinar as well, and I think at that time there was a tremendous amount of bullish fervor in the air. We were rocketing up towards the high watermark for the year of Brent in the kind of mid to high 90s a barrel versus around 80, as you mentioned this morning. I think while there have been some shifts in the fundamentals and the fundamental outlooks from the various agencies we're going to discuss today, they pale in comparison to the price movements. And I think the important thing to understand is, and while a lot of people say that these moves are driven by speculators, and I think that refrain is often overused by a lot of people in the market, I think we have a very kind of firm quantitative grounding in saying that occurred again and very pronounced this last time. I think so. When you saw the run up in September, speculative positioning as measured in the Commitments of Traders report is a great proxy here, reached in the highest level since mid-2021 by the end of September, totaling the equivalent of somewhere around 560 million barrels of notional contracts and futures and options contracts. And that hit that high watermark, helped push us to those highs. And then in the 2 months that's followed have completely kind of disintegrated. First on, I think, a very rational pullback, and then as this momentum just beget momentum, and now we've almost halved those positions, and now speculative positioning now on a net basis stands at less than 300 million barrels, which is, while not its lowest period of the year, very near it, and kind of concluding the fastest and starkest pullback in speculative positioning in the market. So I think while absolutely fundamentals have changed, I think the market is probably a little softer today than we were 2 months ago. I don't think it's materially so, and I think a lot more has been explained by that change in sentiment and that momentum of those speculative investors.
It's a good analysis of kind of the divergence or lack of divergence between the physical and financial layers, Rory. So for me, the last couple of months have been interesting because you've got actually, obviously, a ton of things have changed. We've had economic indicators that are getting weaker and weaker. The World Economic Outlook is flashing that even in the midterm, if you look at GDP growth, we're at the lowest expectations that we've seen in the last several decades. So this is, while it's largely in the OECD, even the non-OECD is not looking terribly strong. Global oil inventories are still quite low, and actually in Asia, they're very low. And then we're kind of rolling off old comparisons with COVID, with Ukraine. So last year there was a lot of gas oil demand because of the high costs within Europe and other sort of things. And of course, the big thing that is luckily not been an issue yet is just the rise of Middle East risks, particularly as we are just past a big anniversary of where oil was really quite a big deal about 50 years ago. And so if you look at all of these, if you look at the kind of geopolitical risks, which are still out there, we are still paying attention to them, versus the economic risks are much easier to quantify, much easier to actually see, versus these geopolitical risks have diminished, which I think is the right sort of thing for them to do. It seems like all players are recognizing, okay, there's some things that we need to deal with, but perhaps we can keep oil off for the most part, except for one country. But let's keep these, kind of off the table. And so I think everything is really focused on that, looking at the demand side. What is the outcome? What are we looking at for China? We've got a return in gasoline demand growth in the United States after a really weak summer with lower prices. So there's a whole bunch of things that are happening in the last couple of months. And if I have to try to do an exercise, which is, okay, if I just knew everything about this market but hadn't seen prices in a year, where would I have expected them to be? And I would say I probably would have expected them to be a bit higher than they are right now. But in terms of the direction, not terribly surprising for me.
Mm-hmm. Well, you mentioned China there, Jamie, and I mean, over the past couple of months, both the IEA and OPEC have revised up their estimates of Chinese demand. However, despite revisions, a massive divergence still exists. I mean, if you look at the IEA, on the one hand, they're seeing 1.8 million barrels a day of Chinese demand growth this year, while OPEC sees 1.1, and EIA sees just 0.8 million barrels a day. So this kind of size of divergence at the end of a year is quite uncommon, because forecasts obviously tends to converge as the year progresses and more data becomes available. So it'd be great to get your thoughts on, why is there still so much uncertainty around Chinese demand this year?
Yeah, I agree with you. Normally, when we get to this time of the year, there's a lot of convergence. I remember when I was at my prior job, I was working with an analyst, and it was in November, and they said, "Oh, our oil market, our oil price forecast is so close to reality." I'm like, "We have 11 months of data out of 12. I would hope that we are pretty close to where the actual average is going to be for the year." But this one is different because so China was slower than everyone else in terms of exiting COVID. It was also a slowdown and a lag. I think that a lot more that was not as expected, wasn't expected by me. I don't think it was expected by many. There was a greater lag than expected in terms of, okay, COVID policies are off now, demand starts to rise up. So there's still a lot of economic uncertainty there. So you've certainly seen growth in jet fuel and all of these other sort of things within China, but not to the same sort of level that many people were initially expecting. And now it seems like it's finally starting to get up to those sorts of levels that we were previously expecting. So it's, reading some of the news this morning, petrochemicals looks like it's dying in Europe and looks like it's just absolutely exploding within China. That said, there is still this kind of look forward view that it's like, oh, we're still dealing with the real estate market and what's going on there. We're still dealing with an underlying youth unemployment that is intolerably large. And so it's a question of how much spending is actually the Chinese consumer willing to do, and how is that going to change demand? And so I think that uncertainty, one, it comes obviously from the quality of the data that you get from the US versus Rory. I know Rory always loves the data out of Canada, and of course China are very, very different. And so it's that uncertainty in combination with everything else that is going on with China that I think is really driving these, and you're right to put it, Tom, real significant divergences between the different organizations. And I think within all of them, that doesn't necessarily mean that there's a truth there. We're still, and my guess would be, because we often don't pay attention to historic revisions, and my guess would be we will be revising this quarter for at least another 18 months or more. Rory, love to hear your thoughts.
Yeah, and I would even extend it. I think the entire year is going to be revised, particularly for China, because, like you were saying, Jamie, China, unlike most of the rest of the world, doesn't actually have, on a monthly basis at least, official demand statistics. So we use what we call apparent demand, which is essentially measuring the rough approximate disappearance of oil within the Chinese economy, which is kind of like, net, gasoline production, plus net gasoline trade gives you a rough kind of approximation of where Chinese gasoline demand should be, for example. On an overall petroleum liquids basis, as Jamie was saying, China has for a lot of COVID remained very, very flat. You had the kind of pullbacks with COVID zero. This year, however, has been staggeringly strong on an apparent demand basis. I would even go so far as to say unrealistically strong. I've published a lot about how these numbers seem way too high to be true. I know the IEF's own Jody data uses a similar kind of apparent demand calculation, and they're also showing very, very, very high, much higher than I think at this stage any of the major agencies are baking in as their kind of core Chinese demand for the year. And I think a big part of that is the fact that a lot of people have talked about this breakaway and this decoupling of petroleum product demand from broader economic activity. Jamie mentioned the real estate market obviously has been in terrible shape. But maybe it's not the thing that's driving petroleum product demand. Maybe we are finally starting to see that snapback and that pent up demand from the COVID era shutdowns. But I think the challenge here is that I think for a lot of countries, or a lot of agencies and a lot of forecasters, given that lack of hard data, that you can always kind of refer back to and start and kind of back update your priors and your model. I think a lot of people are looking at these numbers and saying, these seem way too strong. I don't know if I want to bake these into my updated model, because then we're just going to end up in a crazy place. And I think that's the challenge we see right now. So I think what we're either going to see is finally, a year on, some kind of revelation as to where all this oil was going, or everyone's going to kind of come around and say, actually, we actually did have staggeringly strong Chinese demand this year. I think my numbers are even stronger than the IEA's right now, which is saying something. I'm showing something near 2 million barrels a day, year on year, year to date average growth, which again is just a silly number, particularly in the perspective of the global demand picture, which I think is much weaker, particularly in Europe. So we're having this very funny oil market, and I think it doesn't shock me that a lot of different models and agencies are hesitant to commit to the data we're seeing right now of China, because it is just so wild.
Yeah, very interesting. Well, let's see what happens in the revisions, as Jamie mentioned. But turning now away from demand, looking more at supply. Non-OPEC supply growth has been steadily revised up by all three agencies over the past 5 months. Why do you think this is, and what countries have been surprising to the upside? And I guess additionally, do you think there's still potential for this trend to continue? Jamie, maybe we'll start with you on that one.
Sure. So I would say surprisers are obviously the U.S., Brazil, maybe a bit on Guyana. The U.S. is incredible in that we have cut rigs. I was just looking this morning, 150 rigs since the beginning of the year, and yet we are defying gravity and continuing to bring on additional production. Now, naturally, we have many times and consistently gotten more and more efficient. We can do more with fewer rigs. You all of us briefly spoke as we got going. There's new techniques. AI is quickly jumping into the patch. I know a number of players that are looking to try to figure out use cases to do that. But I would say that is the one where you're seeing some significant divergence there in terms of just between the different agencies. And I think it is similar with what Rory was mentioning with China, which is like, do we want to actually commit to this? And do we actually see this going forward? It's like all the, anything from CEO commentary to the rig count to the price relative to what you would expect them to need, all would suggest that supply growth should start to kind of slow down a bit, and yet it's been growing pretty strongly. And then Brazil, I think I remember earlier in my career, it was like Brazil was the place. This was like there was so much happening, and then it just kind of fell away for a while, and now it is a place again that needs continued focus as they're starting to come back. Rory?
Yeah, just to drill down into something that Jamie had said about the U.S. forecast and kind of put it just into a little bit more of a firm picture on that, just how much that has outperformed. Earlier this year, the EIA was expecting U.S. total liquids production growth somewhere in the ballpark of 900,000 barrels a day, give or take. That has been more than increased by 50%, year to date. And those gains continue to chug along. I would completely agree with Jamie that my own expectations of U.S. production have been greatly exceeded. We have seen repeated increases in efficiency in the past, but I think it just felt like we had such a stark pullback, and coupled with in the rig count, I should say, and coupled with those CEO comments and everything else, it just didn't seem like that was going to happen. But it definitely has. I think it's once again the perennial reminder to never really discount the U.S. shale producer, because they have for a decade plus surprised materially to the upside in a very, very consistent basis. But one thing I just want to mention here as well is I think there's a really interesting kind of sub kind of lesson in here, that if you look at one of the things that's bedeviled analysts and kind of frustrated analysts for a little while this year is the fact that there was a very, very wide gulf that opened up between the EIA's weekly production data, field crude production data, and the more accurate monthly petroleum supply monthly data. That you had these jaws that had opened up, and it was very confusing as to why you weren't updating the weeklies, basically re-benchmarking more quickly to those higher baseline of production. And as I understand it, a big part of that challenge was the fact that the STIO, the short-term energy outlook model that the EIA uses, that we're talking about here, and that drives the weekly estimate, because it kind of just it interpolates into that forecast. That STIO data, that STIO forecast, just kept torquing production down so consistently. It's like, oh, okay, well, that month was strong, but that's the last strong month, and we're gonna crash back down.
Yeah.
And it never happened. So eventually, the modelers threw in the towel and said, well, look, obviously efficiency is that much stronger now. We don't need nearly as many rigs as we thought we did. And now finally we've had a re-benchmarking of that, and the STIO is a little bit more kind of accepting of that level of productivity. But once again, we're stepping into the exact same trap next year, and all agencies expect a near, a reduction of upwards of 2/3 of growth in U.S. supply next year. So I think we're going to be back here, a year from now, saying like, okay, was this the year that U.S. shale really actually slowed down, or did it surprise to the upside by a factor of 2 or 3 once again?
Your point there, just make one more point, Tom, because I think this is an important one. There's been several points in my career where something was changing in the market, and you needed to update your heuristics on, X usually means Y. And I think now we are again at this point, and this is both true for professional analysts, those that kind of watch this on here and there, but it's also important, I think, for for all of the statistical organizations, EIA, IEA, even OPEC, to relook at basically everything from the ground up, because Rory's comments on, this is just how the model works. Well, if we know that's how the model works, then I think it is incumbent upon us to continually relook at how we are examining this market, and update it and freshen it up to something, on what we can actually do now. Statistical techniques are getting much better. Our ability to pull in data is getting much better. I know Rory is always pulling in a lot of great raw data that he just absolutely loves to work with, but trying to figure out how to get that into a spot. And so while we focus on the EIA, IEA, and OPEC, this is true for pretty much any analysis that you are looking at. It has always been true that when we're looking at the oil market, even when we're looking in the past, we aren't looking at ground truth. We are looking at, this is what the model has shown us. And it's important that we continually try to improve our techniques and relook at kind of the assumptions that we have in our analysis.
Yeah, well, that as we were discussing off camera before the show started, I mean, this may be where AI could help to, improve the quality of these models to get those to stop some of those anomalies creeping in. But that maybe that's a topic for another podcast.
Yes.
But I mean, turning now to non-OPEC supply estimates for the end of the year. I mean, so far, the first 9 months of the year was pretty much aligned. But 4Q of 2023, there's a really big divergence of more than 2 million barrels a day in supply from non-OPEC. So what do you both see the risks to non-OPEC supply at the end of the year? And, where do you think it'll pan out in the end?
Rory, you want to take this one?
Yeah, I'll say something quickly here, just on the really, really bizarre Q4 2023 number, particularly from OPEC's monthly oil market report, which shows an implied reduction of Russian headline, oil supply to the market by something like 1.1 million barrels a day. So I think this goes back to a degree of talking about how these models are constructed. I have not seen how these models are constructed in each of these agencies, but my suspicion is that looks to me like a plug in the end of the year in order to keep that annual number averaging closer to what that model initially expected, because both the EIA and the IA are not expecting anywhere near that kind of reduction. In fact, actually see volumes increasing slightly, quarter on quarter. I'll also note that the tanker tracking data I use from Vortexa also shows increased shipments of total petroleum from Russia in October and November as well. So this all says that we should be seeing generally more supply out of Russia versus what, and I think it's, again, for people, in case people forget, we're in Q4 right now. That would imply that right now Russia has reduced production by over 1 million barrels a day, and that doesn't scream to me from what we're seeing in the prices and the curve right now in the market and all the news flow. I think we would have heard about it. So I would say that to me looks more like a statistical anomaly than a true kind of call on the market. But what I also note is that it's an interesting kind of shift relative to where we were kind of going back, when we first had Moscow invade Ukraine. The IEA obviously came out with its huge 3 million barrel a day production loss call. The EIA as well was building in very aggressive declines out of Russian production. Whether or not we can say that was due to a general feeling of political pressure in the West or from Western governments or whatever, OPEC was far more sanguine on Russian production, and they ended up being right. Whether or not that was because they didn't feel the same pressure or because they had, a direct channel into the Kremlin, because, well, now Moscow is a direct member of the OPEC Plus club, so they obviously have, a WhatsApp group or whatever. That I think proved to be correct. This time, it seems very unlikely that OPEC's view on Q4 is going to prove correct, particularly given the fact that I think, if anything, the official story is that the reason that we've declined year to date at all out of Russia is part of this broader kind of bi-unilateral, voluntary deal with Saudi Arabia. And that doesn't seem like it's going anywhere between now and the next meeting. So it would just seem extremely strange to me if we really did see that huge reduction, and that makes up the lion's share of that divergence in Q4.
Yeah, I think your point on there's areas where there's some real uncertainty that's out there, and difficult to grasp what's actually what our data is actually showing us. So Chinese demand, U.S. supply, and then you're totally right on Russia is this that OPEC does seem to be very much outside kind of the expectations, and you're framing on IEA previously was, and now it seems to be that OPEC is a little bit too bearish on Russia and what that supply is going to end up being, because I'm also seeing data where it's like, no, this doesn't look like anything, and their recent announcement that they're going to allow gasoline exports and all of these sorts of things, this is looking like more supply, not less supply.
Agreed.
Great. Well, look, we're on quite a tight time schedule, so let's jump to the next topic, which is looking at next year. And again, non-OPEC supply growth. I mean, maybe this is going to be affected by what you've just talked about with Russia, but I mean, non-OPEC supply growth slowing to 1.2 to 1.4 million barrels a day, which is down sharply from 2.2 this year, and well below the pre-COVID growth of 2 million barrels a day in 2019 and 2.8 million in 2019. So, I mean, can we, is this more moderate growth of below 1.5 million barrels a day? Is that now going to be the kind of new trend going forward? What do you think?
I'll
Kick off,
start
Jamie?
here. Yeah, I'll start here. So I think this is a longer term discussion, and I know Tom, the IEF, has put out some good reports. We got an opportunity to do one with you a couple of years ago, but it still holds true, which is still there is a relative lack of investment in upstream relative to what is actually needed and expected. And so a expectation of lower supply kind of on a longer term basis feels right to me. Yes, we're getting more efficient, but that lower sort of number feels right, with the caveat, of course, that it has felt like the U.S. has defied gravity in the last 10 years, arguably. Always such an impressive growth out of my countrymen. And so I think that's kind of, that lower amount is what I would expect. And I think that lack of investment, the UN put out a report a couple of weeks ago talking about how many projects were being put on. And I think it's a combination of, we need to look at how many projects need to be brought on in order for us to address the climate and meet net zero, the longer term sort of view. But there's also that short term, how much do we actually need in terms of what demand is looking at? And I think we have been running a risk for quite some time of a relative lack of investment relative to what actually is happening on demand, not what is needed to happen on demand. And I think those are and so that lower number of 1.5 or even lower longer term would not surprise me, and that would be that is what our numbers are kind of showing.
Yeah, so I think we had mentioned earlier that the expectation is that United States production growth next year is going to fall by 2/3. That goes almost covers the entire difference between those two growth periods, and I think U.S. will always kind of be the largest, particularly non-OPEC plus supply variable for the next half decade at least, probably longer. I think it's just the resource is so large, the potential is so massive. And as we've been discussing, a decade of upward surprises, I think, that's not something that you can consistently ignore as an analyst. That said, I mean, the next year's production growth from all the agencies looks very, very weak from the United States in the grand scheme of things. Sure, 500,000, let's just say that is the average between them all. 500,000 barrels a day of growth is a staggering growth number in most countries of the world. But based on what we know of the US production system, it's likely that likely means more or less flat crude production and just a lot more natural gas liquids. And to me, that seems, again, like, if anything, unless we get a complete collapse in prices between now and, let's say, Q1 of next year, it seems once again that the risk for me is to the upside of that. Just because at this stage, the risk for U.S. supply always just needs to be considered to the upside of wherever we're pegging it to be. But I think beyond that, I think we actually have a couple other funny, potential surprises next year. I think I'm calling in from Canada and Toronto. Canadian production, I think a lot of people are having really strong expectations of next year, more or less given a weak base effect in this year. We had wildfires and heavy maintenance in the oil sands. Given the fact that we expect to have the Trans Mountain expansion pipeline coming on and continued growth through that period, some people are expecting kind of 200,000-300,000 barrels a day of growth in Canadian liquids on an average basis year over year. And then Jamie had mentioned earlier the two other countries. I mean, this is essentially, non-OPEC is essentially the Americas now. It's Canada, it's the United States, it's Guyana, and it's Brazil. Those are the big four that are going to continue to drive that non-OPEC supply picture in the near term, as well as a couple other, particularly offshore countries around the world where there is promise, but it's still nascent. But those countries, that's where we know we have a proven track record, and in many cases, continue to surprise to the upside. So I would expect that to be, whether or not 1.5 million barrels a day is the steady state going forward. I think steady states going forward is the perennial question in all of the oil market right now, post-COVID. I think we don't really know what any steady states look like at the moment, but I think it's a reasonable expectation. But I think the other question is, and we'll talk about demand expectations in a second, but if non-OPEC supply is growing at 1.5 million barrels a day, what's OPEC going to do? Because that doesn't actually leave a tremendous amount of room for OPEC itself to grow production back and kind of start to begin to claw back these cuts they've embarked upon.
Absolutely, yeah. And in fact, as you correctly predicted, we are going to talk about demand now. And looking at the forecast, OPEC continues to see 2 times more global demand growth than the IEA. So they're seeing like 2.2 million barrels a day versus 0.9 for the IEA. So what do you see as the major risks and drivers for demand growth next year?
GDP. And I think that is really what the big driver is. I think, I'm really alarmed by the world economic outlook with that lower growth that you're seeing. And yes, we've been looking at that for some time. I think a year and a half ago was when I first started talking with people about the potential for, and our own company was started talking about the potential for a slowdown. And you've definitely seen some slowdown in different patches, but just trying to understand what is going to actually happen with GDP, both at a global level, but also at a regional level. There's also, they rightly highlighted concerns that I have on geoeconomic disintegration, which is basically a lack of global of world trade. So world trade peaked as a percentage of GDP in about 2008, but these concerns about, as we've looked at, and I know, Tom, you at the IEF have looked at critical minerals. You look at some of these issues that are happening in those markets, which are obviously outside of the oil market, but the potential for geoeconomic disintegration to slow down, that could actually impact academic analysis suggests that can reduce GDP by 0.2 to 12%. And we're going into a period where we're looking quite soft in ways that we have not looked for quite some time. Not quite at the 2008 level, but that's, when I look at it, that's what I'm really paying attention to. Are the U.S. drivers going to be there next year? Is Chinese demand going to be there, or is it really going to be as weak as everybody says? What are the impacts in terms of inflation? Are we finally kind of past the main sort of issues on inflation, or is this still growing? And so those, I think, are the big, broad questions that are going to matter for next year if we are heading towards a much slower kind of longer term demand growth because of economics, as well as the longer term impacts of EVs and everything else that are kind of changing the market.
Yeah, so I think when you look at these numbers, historically you could typically pre-COVID come up with a global GDP number and have a pretty good bet on what oil demand itself was going to be. Now, it couldn't feel farther from the truth. We were discussing earlier that the Chinese economy continues to underperform expectations, but Chinese oil demand is running gangbusters. It's very, very difficult to kind of put those together in any of the traditional models. And we discussed updating models earlier, but it's really hard to know, coming out of COVID, now we've done the easy part, if you will. We've recovered to pre-COVID, pre-COVID levels. Now it's a question of do we continue to see passenger flight activity continue? Do we continue to see all of these things that were historically driving that economic growth, but I think more specifically that growth in fuel demand, will those continue? I think there are massive questions about whether or not this is going to be the case. And I think what makes it even harder, I remember, I can't believe it was already half a decade ago, but in 2018, the buzzword in the macro community was a global synchronized recovery. And this was this idea that the entire world was traveling together, this one giant macro trade. And now it seems like Europe is kind of in the tank, at least from an oil demand basis. China and India are raging forward. North America is more or less flat. They're all sending completely different signals. Going ahead to next year, it actually seems like the IEA in many cases is building in mild recessionary conditions, expecting an annual contraction in OECD, product demand. But again, these are really, really, really big differences, and they go a huge way to explaining why the EIA expects mildly bearish conditions next year. A very, very mild surplus in the market, whereas OPEC is seeing something like 2 million barrels a day of deficits on average through next year, and that's just a staggering difference. And I think again why the market, really can't latch on to any particular consensus, because there is no consensus to latch on to right now.
Yeah, well, you led me perfectly into the next question. We've just got 5 minutes left, but I mean, we've got an OPEC meeting coming up this weekend, and if we look at the call on OPEC for next year, estimates diverge by more than 2 million barrels a day. So, what do you think will be the key drivers for determining who's right on the call on OPEC, and what are the great risks and uncertainties for next year?
Rory, you start with this one.
All right. So I think, obviously one of the things that we have to watch here, I mean, right now, I was mentioning at the beginning, we had spec come in, spec come out, prices up, prices down. Prices are very volatile. So I don't think that provides a huge amount of useful guidance to OPEC ministers going into this meeting, because I think, honestly, more is happening with the price than is warranted in this moment. That said, I would, you've already started to see the rumor mill start up with OPEC. You're starting to, now they're considering 1 million barrel a day cut on top of everything else. Or maybe the Saudis are considering punishing or kind of pushing back against other OPEC plus members for cheating on quotas or anything else. I think at this stage, I think a lot of people see a lot of stuff happening in the crude oil market and expect a commensurately active response from OPEC. But my hope, at least going into this meeting, is that OPEC more or less sits still, waits until what we see is really coming in next year. I think at the most, my expectation would be to see a formal extension of the unilateral cuts. I'll call them bi-unilateral cuts from Saudi Arabia and Russia. I think people have been talking for a while that maybe those cuts were going to ease off and come back, and production was going to come back in the first quarter of next year. My expectation was that unless we had either a major, U.S. broker deal that was going to, get Saudi Arabia to formally acknowledge, Israel and get some kind of U.S. defense pact out of it, some kind of tangible benefit for Riyadh. Unless you either get that or you have prices in the triple digits, I just don't see any reason why this is the moment that they're going to pull back and kind of embark on such a stark about face in the market, when up until now, it's all been about, punishing and scaring the shorts and supporting stability in the market. It just seems to be, it would be a massive trend break from what I do consider to be recently a new style of Saudi market management. But I think that, the evidence we have thus far would be a big change. So I'm not expecting a huge amount from this. And as to, your question as to what's going to be the real driver as to who's right, ultimately it's going to be OECD, visible, and most specifically U.S. inventories, which are low, but frankly aren't as low as many people, myself including, would expect given what we see in terms of the implied supply deficits going on globally. A lot of this comes down to, opacity in the Chinese inventory market, et cetera. But I think that's going to be the ultimate arbiter of who is right, is where, U.S. crude stocks in those weekly numbers actually trend, because I think that is no one can hide in those numbers.
Jamie?
So yeah, we're a little under a week away from the OPEC meeting, which means we are probably, and as Rory said, the rumor mill is starting up. So there's Reuters reports that are coming out this morning, a couple of other things. I'm chatting with a couple of other people, and I expect that it will be quite dramatic. My expectation is also that we're going to roll forward, and it's not going to be a significant change. But I anticipate OPEC ministers are extremely deft at using the press and using analysts to try to gin up and try to express kind of their views on the market, which then can end up creating a great deal of volatility. But if I was to guess, we're going to go through this and we're going to exit it without really any change in policy at all. And I think partly they need to, and they will want to look at the data. Partly, it seems like the price drop has largely stopped. And also, you have to look at this in terms of the broader global context. We are going into the COP meeting at UAE, and I think OPEC will want to be able to show that it is still a reliable partner. And so less news, meaning kind of continuing to move forward. That said, there is still, I think, an outside risk that you could end up seeing a sharper drop and a change. But it takes quite a bit for actually a lot of organization and for a lot of discussion to actually come to that sort of move. So I would expect lots of news over this next week. but at the end, we're probably going to exit without any real change.
Okay. Well, thanks both of you, Jamie and Rory, for such a great discussion today. And that's all we've got time for, I'm afraid. But thank you to everyone attending and watching today. And stay tuned to the IEF for more insights on the global energy market soon. This is Tom Ashby signing off from the headquarters of the International Energy Forum, the global home of energy dialogue. Goodbye.